So now we're going to try to understand CVP, cost volume profit analysis. This is sometimes the thing to understand of changes volume of activity on its costs, revenue, and profit. Cost volume profit analysis can be extended to cover the effects of profit on changes in selling prices, service fees, core services. So while the term profit appears in this analysis, cost volume profit analysis is not confined to virtually any business operation. The entire series of consultants managerial accounting book. I have the 9th edition of this book, which was the 2010 issue. You can find or at your local bookstores. Is 7-42. This will be used as our case study to understand cost volume profit analysis. We'll go through the formulas right alongside, and we'll do the application right alongside. The question says the division of worldwide reference corporation produces a pocket dictionary of phrases in 6 European languages, annual 1,000 books. This means that they've given us the number of books. Sales are, when we've been given total revs price, if sales are $1 million per unit, and the sale price per unit will be total sales, 1 million, divided by number of units, 100,000. This will give us a sale price per unit of $10. Next, they've given us costs. We have direct material and direct labor variable costs. We have a fixed portion of manufacturing overhead at 100,000, straight cost at 110,000. What we want to use is the fixed cost total and variable cost total. Begin with our variable cost. And the sum of our 100 plus 150 plus 50, that makes 700. And because this is our total, we want to be able to calculate the variable cost per unit. So that will be $700,000 divided by 100,000 units. This will give us a variable cost of $7 per unit. Next, we need to incorporate our fixed costs. Remember that we only need the total fixed costs. We'll take the total amount from here. That's $210,000. Based on all of this information, we want to be able to calculate specifics within the question. So when we have our fixed cost, this will allow us this information will allow the first requirement is calculate the break-even point. Calculate the break-even point in cost divided by contribution margin. Now the contribution margin in this case is going to be the contribution margin per unit. I'm going to do the sale price per unit minus variable cost per unit. So sale price is going to be $10 and variable cost is $7. That means that we have a contribution margin of $3. Once you have your contribution margin and you have the total fixed cost, that's 210,000, you can calculate the break-even in units. So our break-even in this case is going to be $210,000 divided by 3, that'll give us 70,000 units. So you must sell 70,000 units to break even. And remember, break even means no profit, no loss. When you sell 70,000 units, you will not make any profit, but you will also not make any loss. Next, we have to be able to calculate break even in sales dollars. There are two ways to do this. The first way, when we calculate break even in dollars, is going to be fixed cost, its formula ratio. Okay. So we have 210. Oh, that's going to be any formula. Here we do this. Contribution margin ratio. The formula to calculate this is contribution margin divided by sale price. The other way to write that would be sale price minus variable cost divided by sale price. Each of these is per unit. Okay. So our sale price is just $7 and our sale price is $10.30. We still have our fixed cost. Dollars is going to be 210,000 cost share. Part 1 is done. Now let's do part 2. Part 2 says division is subject to an income tax, the company would have to sell to earn an after-tax profit of the income statement. 20,000. Minutes, right in the middle of chapter. We do deal with the tax effect. We basically need to understand that our profit will divided by its rate. We want an after-tax profit of $90,000, and we'll divide that by 1 minus the tax rate, where the tax rate is 40%, so 1 minus 0.40. Using our calculators, if we do 90,000 divided by 1 minus 0.4, we get 150,000. Means earn a $90,000 and $50,000 modified using the target profit formula. So we modify that. We say target profit formula is actually equal. This is a modification on your break-even formula. Your Working with part number 3, it says if fixed costs increased $31,500 with no other cost or revenue factor changing, compute the firm's break-even sales in units. This means that something in your formula is changing because we're going to sales in units, we will apply, which is fixed cost divided by contribution. But we have a new fixed cost now. So we'll take our original $31,500 and $41,500 as our new fixed cost. Plugging this into our formula, we get a new break-even, 241,500 divided by 500 units. This part 3. Working with part 4, it says we're going to do two things here. We're going to create a cost volume profit graph and right alongside that we will also create graph. We already know that actually on both of these graphs, our y-axis is always going to be dollars. And our x-axis, careful with which units you'll be taking. Calculations verbally and write only as much break-even point. So we'll take our units and we'll put units in here to make one. Let me create a singular table for both. We'll do units here. And we will do revenue calculation here, put calculation over here, because we'll be using the same number of units. Both the first number of units that we'll take is a break-even number of units that's in the same range. So I'm going to go 10,000 units below this, 1,000 units above this, that'll be 80,000. Now we'll calculate the revenue, and all revenue at break-even will be 0 because it's so sorry, just 1 minute. So we'll just take this step by step. Price, variable cost multiplied by the number of units. This means that at 60,000 units, this will be plus 60,000 multiplied by 7 is our variable cost plus 210,000. So our profit is going to actually plus 210,000. That gives us 770,000. and therefore our profit will be. We'll use all of this for our CVP graph, and we essentially just need to start over here with a break-even point. That's 70,000. The K to denote over here for 80,000. On the y-axis, we need to be a little bit more careful of how we start and how line. We know that at 60,000 of revenue way that I can adequately create the lines. 5, 6, 7, 8. There we go. So we'll make this 800,000, 700,000, 600,000, 500,000, where 1 is equal to. So at 70,000 units, we have, see that dot over here. It's 60,000 units over here. So it's 70,000. Here we go. We have 700,000. At 60,000, we have 600. Oh, I don't know why that's not staying. At 60,000, we will come right around here, and at 800,000. Here is our 600,000. Here is our 7. This is a revenue stream. Now keep in mind that revenue will start at 0 and then cross through these 3 points. Please excuse my. The important point are the 3 points. There we go. Now let's go to our expenses. Our expenses will always begin at our fixed cost. That's 210,000. This is our revenue graph. Fixed costs will begin at 210,000. This will be our starting point. Then at 600,000, they'll be at 630,000. So they'll be slightly above this point there. Let's create a first line there. Then they'll cross over to 700,000, and then they'll come right here at 770,000. This is our expenses line. This part indicates loss. This part indicates profit. This part indicates break even. And this is how we make a CVP graph. Using this information to create a profit volume graph, let's create a line over here for 70,000, one over here for 60,000, 30,000, and negative 30,000. Keep in mind that at 0, your expenses would be your fixed cost. That's 210,000 in loss. So we start this line from here. We go to 30,000 at 60,000, 700,000 here, and 300,000. We cross all of these points, indicating the 3 points, and crossing the graph is essential. This part indicates loss. This part indicates profit. This means part 4 is done. Now we move on to part number 5. Part number 5. It indicates due to an unstable political situation in the country in which the European division is. If this happens, the tax rate could rise 50%. Assuming all other ground problem, how many pocket dictionaries must target is still 90,000 in units. Once again, we need a pre-tax profit, which will be equal to after-tax profit divided by 1 minus the tax rate. So that's $90,000 divided by 1 minus 0.5. We get $180,000 as our pre-tax profit. Our target units will be equal to fixed cost plus pre-tax profit divided by contribution margin. Our contribution margin is still $3, so we have $210,000 plus $180,000. $200,000 fixed costs plus pre-tax profit divided by $3 contribution margin. So $210,000 plus $180,000 gives us $390,000. When we divide this number by 3, we get 130,000 units. Now, this means we're done with this question. I just want to remind you of one other concept that we've done in class. One is sensitivity analysis, and one is scenario analysis. Now, in sensitivity analysis, we change one factor at a time, and in scenario analysis, we change all factors together. Change one factor at a time. And in scenario analysis, we change all factors together. Using the information from this particular question, we're going to change a few factors here. So let's increase our fixed cost by 10% and see what happens to our break-even point in units. This means that our new fixed cost is going to be equal to 210,000 times 1.10. That when we plug that into our calculator, we get $231,000. Using this new fixed cost and all our existing information, we'll now calculate our new break-even, which will be $231,000 divided by a contribution margin of 3. We get 77,000 units. This means that if fixed costs increase, our break-even in units also increases. Now let's see what happens when we increase our sale price by 10%. That means your new sale price will be equal to our original $10 times 1.10, or $11 per unit. Now the sale price directly affects your contribution margin. That means your new contribution margin will be $11 minus the original variable cost of $7. So you get a contribution margin of $4 per unit. We'll use this new information to calculate our break-even in units with our original fixed cost, because remember, this is sensitivity analysis. So we're only changing one factor at a time, and that factor is sale price, nothing else. So $210,000 divided by 4. When we plug this into our calculator, $210,000 divided by 4, we get 52,500 units. This means that if sale price increases, our break-even in units will decrease. Similarly, let's see what happens when our variable cost increases by 10%. This means our new variable cost will be equal to our $7 multiplied by 1.10, or $7.7. This will affect our contribution margin. So we'll take our original sale price minus $7.7, which is our new variable cost. 10 minus 7.7 gives us a 2.3 contribution margin. We'll use this as our new input in our formula. So break even will be $210,000 fixed cost divided by 2.3. Plugging that into our calculator, 210,000 divided by 2.3, we get 91,304.3. We always round up in the case of units, it's 305 units, which means if variable cost increases and all else remains the same, your break-even units will increase. Now, these are 3 things that have changed individually or independently in a sensitivity analysis. When we do a scenario analysis, and you see, in fact, the impact of each individual change on our total break-even. Now, what we want to do is we want to change all 3 factors at the same time and determine what will happen to our break-even in units. Now, for the sake of this question, I'm going to alter just one case. We'll still use the increase of fixed cost at 10%. We'll still use the increase of sale price at 10%, but we'll do a decrease in variable cost at 5%. So your fixed cost will be $231,000. We know this because we've already calculated here. Our sale price will be $11. We know this because we've already calculated here. A decrease in the variable cost of 5% will be $7 times 0.95, which gives us a variable cost of $6.65. This allows us to calculate a new contribution margin of 11 minus $6.65. Which is $4.35 contribution margin. Now we'll calculate our new break-even based on this scenario analysis, and that'll be our new fixed cost, 231,000 which remember will always round up, so 104 inch together versus when they change. Because in our economies, when things in sensitivity analysis, this is just done to changing scenarios on our baseline. Thank you very much.